Wednesday, October 9th, 2019, Maneco 64, home of alternative economics and contrarian views. Before I start this morning, I'd like to thank all my existing subscribers, all the new subscribers I'm getting for their continued support and interest in the channel. As you know, I've been to Italy for the last week. We visited Florence. It was a great place to visit. Very historic, a lot of art, a lot of history about money as well and banking. And we happened to be able to take the train to Pisa. And in Pisa, aside from the Leaning Tower, I visited the statue of Leonardo Fibonacci. Technical analysis, for those of you who do technical analysis, Fibonacci retracement. That's named after Leonardo Fibonacci, a mathematician of the 12th century. With that, I've done a t-shirt, designed a t-shirt on my Teespring store with me, with a picture of me with Fibonacci. And in the back of the t-shirt, you got his golden spiral. Bit of fun, the merchandise. Link to the Teespring store is below in the description. I think YouTube now puts the link below as well. It's like a set thing. Anyway, this morning, before looking at the markets, I'll look at the markets towards the end. I want to talk about hyperinflation, how it's very different from normal inflation that we've had for the last 50 years, I would argue, under the fiat money regime, the dollar without the gold anchor, right? Hyperinflation is very different. The inflation we've had in the West and in the US is more like this. It's linear, right? Hyperinflation is completely different. It has nothing to do with a cost push, as it's called. Hyperinflation is a loss of faith and confidence in the national currency. In this case would be the dollar. And does that mean that you can protect yourself by being in Swiss francs or euros or British pounds? No, you can't protect yourself through any fiat currency when there's hyperinflation in the reserve currency, which is the US dollar or the petrodollar, right? And why does that happen? Well, in my opinion, and from what I've studied about in the past, is that people lose confidence in the central banks, the monetary authorities, the state. Doesn't matter which party, they lose confidence in their leaders. And they want to get rid of this promise, this paper promise that is managed by these central bankers, by these politicians. They want to get rid of it, so there's no demand for the currency. There's people want to exchange it for anything but that paper currency. So it's a geometric event. It's a chart of fear, like in commodities, right? Commodities, when people fear things like oil goes up or gold goes up, that's the chart of fear. And for currencies, when they collapse, is the chart of fear as well, but it's on the downside. So what benefits from that? How can you protect yourself? Well, by having your savings, if you're able to have savings these days, and protect your wealth through tangible goods, through being out of the currency, of course, not having too much, how can I say, unsecured loans with banks, because that's what money in the bank is, right? It's you giving unsecured loans to them. That's the key, having just enough there to pay your bills, and the rest being outside the system. In Germany, during the Weimar hyperinflation, and other countries in Central Europe, a lot of, how can I say, paper assets, insurance contracts, they got wiped out because they're denominated in the national currency, of which people lost confidence in. Recently, of course, we've had Zimbabwe, Venezuela, people losing faith and confidence. When will it happen? Can we measure and extrapolate, try to forecast? No, that's the thing. It's almost impossible. But why am I talking about it? Why do I think we're getting closer to that kind of event? Well, because the central banks now are confirming that the route they took in 2008 and 9 after the great financial crisis is one out of which they cannot get out. There's no exit. And well, if they exit, it's like they go down a cliff. But if they stay on this route, there's going to be an even worse cliff in front. And that's because once you start printing money to monetize debt, create credit out of thin air like the central banks are doing, once you do that, there's no way out, because the system becomes addicted to it. And if you stop it, the system wants more, and that's what we're getting. I've been telling people this before I started my channel, that it would happen like this, mainly because I've read about it in the past. There's never been an experiment with paper money, especially one in which they've had to start monetizing that, which succeeded. Like von Mises said, it's a crack up boom. Eventually everything implodes, and that's hyperinflation. It's not, how can I say, linear. It's not because of costs going up. It's a confidence event. And how do you protect yourself? Well, you can't protect yourself once it starts. It's too late. And that's why I've been telling people that I personally have been trying to accumulate precious metals, get out of debt, not have exposure to the system as much as possible. This is not advice, it's just my opinion. You should do your homework as well. I'm not here to tell you what to do. I'm just trying to give you my opinion, and if you think my opinion is worth listening to, you do. If not, it doesn't matter. So I think that's where we are, because the biggest sign of this is the Federal Reserve, of course, the major central bank of the world. Does that mean that the other central banks haven't done anything wrong and that I'm slagging the American central bank? No, they're doing it all together. But the Fed is very important, because if the Fed sneezes, the whole world catches a cold, so to speak. And the Federal Reserve, through Jay Powell, and a little bit maybe through Janet Yellen, started to try to normalize a policy, to go back to the pre-2008, right? To take the exit from this road of perdition and ruin, right? And they realized they couldn't. And I think this year has been the year that the general public is finding out about it, and the mainstream. They try to raise rates. They're supposed to be raising rates this year. They're supposed to be continuing to unwind their balance sheet. But what are they doing now? They realize they can't. Well, they're cutting rates again. They're going to do QE again, as Powell announced yesterday. So yeah, the die is cast, so to speak. So Powell has crossed the Rubicon. A lot of analogies here and like old expressions, but that's what it is. Yes, we are in uncharted territory. We've seen hyperinflation before in the past in individual countries, but now it's going to happen worldwide. It will be something we've never experienced. I don't know when it's going to happen, but it's better to be prepared than not prepared. So let's look at the markets this morning. It's 8:17 a.m. London. Yesterday, quite an interesting day. When the Fed announced QE, Jay Powell, the market rallied and almost went back to unchanged. I think the Dow was down about 60, but then it completely melted down. So it was quite interesting. The Dow finished down 300, 1.2%. S&P finished down over 1.5%, or down 45. NASDAQ 100 finished down 132, 1 and 2/3% down. So right now we've got spot gold 1508.66. That's up about 3. Range has been 1503.86 to 1509. Silver is continuing to outperform, which is a good sign for precious metals. I've spoken many times in the past, and many of you know that in the bull market in precious metals, silver is supposed to outperform gold. I think the ratio now is back down towards 84, 83. It's been quite choppy, but I think we're going back down now. So silver is up 17 cents at 17.89. Range has been 17.91 to 17.66. The Dow is up 49 points, 0.2% right now, 26,212. S&P is trading below 2,900 now. Even though it's up 7, it's 28.99. Range has been 29.03 to 28.88. NASDAQ 100 futures up 0.25% as well at 76.23. Fiat currency sterling is at 122.16, down slightly. Euro is up 0.2% against the dollar at 109.80. The dollar is unchanged against the yen, 107.15. Dollar's down against the Chinese currency, 0.25% at 714.70. WTI crude unchanged, 52.85. Brent also unchanged, 58.03. And to finish off, the bond market, 10-year yield is at 153, unchanged. 2-year, 141.5. That's down 1 basis point. I guess we're going to see another rate cut by the Fed. I think the meeting is sometime at the end of October. I don't know the exact date. I will look into that, of course. So there you go. Hyperinflation. As the proverb says, it comes like a thief in the night. And if you're not prepared for it, it will be too late. If you enjoyed this video, make sure you hit the like button. Make sure you share it far and wide as well with others you think would enjoy this kind of content. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.